Um, Renowned investor Ron Barron said in an interview that investing in Tesla long term has the potential to make you extremely wealthy. With a 1% stake in Tesla Inc., Ron Barron predicted in 2016 that the company will rank among the most valuable companies in the world at the time. One of the leading investors in the electric automaker was his company, Barron Capital Management. The $4 billion profit from the gamble paid out, but Barron thinks it's just the beginning because there's still room to increase that amount in the next 10 years. What sort of investment approach does he employ? Why does he think so highly of range? Renowned investor Ron Barron has long been one of Tesla's top backers, and he has no intention of changing that. Barron recently stated to CNBC that he intends to retain Tesla's soaring stock for at least the next 8 years, and that he thinks the company still has a lot of space to rise. If you're not familiar with Ron Barron, you're probably new to Tesla stock. As we previously stated, Barron Capital Management, his firm, was one of Elon Musk's major investors in 2016. Barron Capital Management held a 1% stake in the Silicon Valley vehicle. Barron said, "We invested $380 million, or 1.5% of our assets at the time, between 2014 and 2016. We have already turned a profit of $4 billion, and I predict that we will triple or quadruple that amount over the next 10 years. Barron gives his first rationale for investing in Elon Musk's electric car business. With Tesla, I thought the potential of converting the automobiles we make in the United States from petrol to electric was a reality. Barron's own investing company, Barron Capital, is a long-term stock investor with a focus on growth equities possibilities. With Tesla's incredible rise over the past 3 years, it currently has around $6.2 billion, or 12.8% of its total assets, invested in the maker of electric vehicles. A total of $58.9 billion in assets are managed by Barron Capital. Between 2014 and 2016, Barron's own company invested over $380 million in Tesla at a price per share that was marginally higher than $50. Barron reported turning a profit for his clients of $54 billion, of which about $6 billion came from Tesla, in which he had invested $380 million 7 or 8 years prior. He also anticipates Elon Musk's other company, SpaceX, to achieve a similar degree of success. He thinks the rocket firm might revolutionize the $1 trillion satellite broadband market by applying the same qualities that made Tesla successful: a desire to attempt new things in an industry that is set in its ways and a focus on cost reduction. Barron noted in a Bloomberg Wealth and David Rubenstein episode that innovation is happening at the speed of light. They even use space in the same way that they do with automobiles. Despite the odds, Barron sold 1.8 million Tesla shares for his firm's clients in March of this year, describing the deal as sad but necessary for risk mitigation. Barron claims that you have to be in it for the long run in order to really profit from Tesla, and he doesn't seem to be ready to cash in just yet. Barron says it is far better to hold than to sell at this time, even if he thinks he may still sell Tesla shares to lower his customers' risk. Barron says investors should ignore short-term hiccups in the road, such as Tesla's most recent delivery error. I think he's correct in saying that the business has been doing okay, notwithstanding the performance of its shares. More volatility has been experienced by Tesla Inc. than by any other stock in the history of the auto industry. Thanks to its equally controversial CEO, Elon Musk. It has evolved from a disruptive upstart to a social media favorite. No company has better reflected the purported speculative overvaluation of the market than the maker of electric vehicles, whose stock price fell precipitously in the first quarter of 2022. Concerns about potential inflation, growing interest rates, and European war have all added to the stock's continuous downturn. Nevertheless, the market as a whole suffered. Thus, this pattern was not exclusive to Tesla shares. Barron, meanwhile, is not concerned by the price of Tesla stock. He said in the interview that for a few years, the company's size increased and the stock price was rather steady. But thus far, thanks to its technology and software advancements, increased manufacturing and delivery, and self-driving infrastructure, Tesla's price per share has increased fivefold. In an era where index funds and exchange-traded funds like GFs are gradually surpassing stock pickers, Barron Capital's success as a traditional mutual fund provider stands out in hard times. Barron has repeatedly stated that he has never faltered in his faith in the company. Even though he personally owns more than 1 million Tesla shares, he claimed that if he had his way, his corporation would purchase more of the company's stock. We believe that the company is in fantastic form, and Barron's guidelines of focusing on the business rather than the market emotion is sound advice. Notwithstanding the challenges it has encountered thus far, a number of analysts think that given the company's recent product developments, Tesla is poised to achieve its objectives for 2022. Barron thinks that over the next 10 years, revenues might rise from $35 billion to $50 annually. This might lead to car sales of around $750 million. That doesn't even account for the fact that Tesla is now manufacturing its own battery cells and plans to significantly expand that output in the upcoming years. Barron tells me that batteries are another amazing sector that I'm quite excited about. In the next 10 years, you'll see a five-fold gain with that kind of valuation. Regarding what precisely will propel Tesla's growth even further, analysts are divided. Tesla's success has been predicated on the idea that self-driving cars will revolutionize transportation. Despite the recent relative success of Tesla's autopilot and full self-driving suits, Morgan Stanley analysts doubt that the automaker's growth and development will be fueled by autonomous driving initiatives. Rather, the bank is placing its bets on Tesla's mainstay, which is the production of cars, in addition to other strengths like supply chain management, infrastructure expansion, and the acquisition of raw materials. Though CEO Elon Musk has stated since 2018 that the automaker would continue its journey towards fully autonomous vehicles. It is no secret that Tesla's FSD and robo-taxi objectives have failed. But every year seems to bring with it a fresh set of challenges, be it related to production or the supply of necessary components, which pushes back the delivery of a fully functional FSD suite or the planned deployment of the robotaxi fleet. But this has raised doubts about whether the electric vehicle company will be able to sustain its extraordinarily rapid development through one channel and not another, manufacturing, which Tesla has shown it is adept at. Focusing on what Tesla does best is the real route to growth and higher valuations. According to a recent note to investors from analysts, including Adam Jonas of Morgan Stanley, Tesla has increased car deliveries for 9 consecutive quarters by concentrating on increasing manufacturing accuracy and efficiency over the past few years. Though that run of luck might be ending, there is still evidence to suggest that Tesla's manufacturing capabilities are the best way for the company to continue growing, even with the closure of its most productive facility in Shanghai. Tell us as competitors. Right? Tesla can only expand in the upward direction, whether its growth is due to its inventive traits or its production capabilities. Superstar investor Barron says that waiting it out and making long-term investments is the greatest way to make a fortune with Tesla stock. You risk losing a lot of money investing in Tesla stock since it is just too volatile to generate consistent short-term profits. Many experts raise their target prices as a result of a number of events, including Tesla's recent earnings call performance beyond analyst forecasts and the opening of additional plants. The analysts argued that Tesla's competitive edge over original equipment manufacturers and its ability to turn a profit even in the face of supply chain disruptions and operating at reduced capacity made the update worthwhile. Without a doubt, the company will advance past its current position and become even more relevant as it expands and creates new goods. More long-term wealth creation than temporary benefits is possible since electric car delivery and manufacture are directly correlated with profit margins. How do you feel about Barron's approach? Post a comment below.